Tax season is right around the corner, and there may be some stuff that you're not sure about. Here to talk with us this morning all about it, what he calls black magic from the IRS, is Brent Wilsey, Wilsey Asset Management. Brent, good morning. Good to see you as always.
Good morning. Good to be here.
Black magic from the IRS.
Yeah. And black magic stands for selfish purposes. That's what black magic is. Evil, selfish purposes. That's what it is. And that's why I feel the IRS is doing this. But they kind of trick you. You got to understand, first of all, what's called adjusted gross income. Now, adjusted gross income is like, I think, line 11 on your return. And it pulls in all your income, like your wages, self-employment, dividends, capital gains, all that. That's what it pulls in. Well, there used to be a thing many years ago when I first started in the business called alternative minimum tax. That is gone. Now they have this magic. And I say magic because magic stands for modified adjusted gross income. I add concern to it because people have to know about this and they forget about it until they get their taxes. Well, what happened to my deductions? Well, what they've done is they change things for you without really telling you this.
Okay. So what do I do?
What do you do? You got to know some of these there, yeah. And the thing is, and what's kind of funny is that when you do these automated things, you know, Quicken and so forth for your tax return,
sure.
It puts in there automatically, so you don't know maybe if you were to lose the deductions. Let me give you an example of one that will reduce your income. You're a younger person, you're doing your IRA contribution. You do have a 401k at work, but you say, I don't want to do the 401k, I want to do my own IRA. Okay, that's fine. You're making about $74,000, $75,000 a year. You also have student loan debt. Well, you're paying down that student loan and deducting the interest. Sorry, you're making too much money. You have a plan at work. The IRS says, we're going to modify your income. We're going to add back in that deduction you took, or part of it, because it's graduated, part of that from your IRA deduction. So you won't get the full $6,500. You may only get $5,500. Well, how can this be? I did everything I was supposed to. It's because, again, that black magic comes back and they change it, saying, no, you can't get that deduction. We're going to take it away from you.
Okay, I'm going right down your list here.
Sure.
Too much muni income, whether you take it or not, can increase your Medicare premiums. What does that mean?
It gets confusing because, again, we talked about the younger people. Now the older people, you're 65, you're retired, you got a nice income coming in, you've done everything right. Well, you say, I don't want to pay more taxes. I'm going to put this into muni bonds and get tax-free income. Well, you can do that, but here again, the IRS comes back in and they say, you know what, you're taking too much tax-free income. We're going to now have you pay more on your Medicare premiums because we're not going to let you take the whole thing. And people think, well, I'm not going to take that income. It doesn't matter whether you take that tax-free income or you leave it at the brokerage firm or in your account, whatever it may be, it doesn't matter. It still adds back in, and you got to pay more Medicare premiums because you had higher income from tax-free. They're very tricky about doing this, and unfortunately people don't know this, and they're all excited about these plans, like I can get this deduction, that deduction. Then you go to your tax person, nope, sorry, you don't get that, nope, sorry, you don't get that. You want to plan ahead, and there's a few things you can do to help out on that. Okay,
and lastly, 401ks, HSAs, flexible spending accounts for dependent care healthcare costs.
And these are ones that you can do that they will not add back in. You got to know that. We've talked here on KUSI many times about the 401k. Here's another benefit of doing the 401k. You can get that money into the 401k, many times get a match from your employer, and it won't be added back into your deductions so that you're going to, well, gee, they took that away from me. They won't take that away from you. Same thing with HSA, health savings accounts, anything you're doing for health care. These are things that they will not take away from you. So understand the rules a little bit. And unfortunately, right now, this is tax season. It may be too late. You might get hit with that, but learn from it and don't do it again for your tax year 2024. And also, many times I tell people, talk to your tax person. They will tell you this stuff if you ask the questions. So make sure you understand that.
Yeah, that was the first thing that comes to mind. Sounds to me like I need a tax professional.
You do many times, and it depends on how complicated your tax situation is. If you have a small business or real estate, you probably definitely need a tax person. If you don't have that complicated return, you still need a little bit of help because you may miss some of these.
Sure.
I'm going to say if you're probably making between $70,000 and maybe $100,000 a year, you probably want to talk to a tax person. And the ones that I know, they'll tell you, yeah, you really don't need this, but just do that. Also, too, we have a financial planner at our firm. He knows a lot about taxes as well. He's a fee-based planner, so make sure you don't go to the ones that are going to sell you products, but go to a true fee-based financial planner, they generally know about taxes and they can spot it as well. So tax person and a good financial planner too that can help you out to stay away from this and get all the deductions you can get.
All right, Brent Wilsey, Wilsey Asset Management. Thanks, Brent.
You're welcome.
Appreciate it.